Hi, this is Mark with the analysis for the week commencing the 19th of May. In the last few weeks we've had major US dollar strength across the board, across all pairs. And even last week, when the news out of the US wasn't even particularly positive, still the dollar powered on and gold fell. It is not logical. The dollar economy has not suddenly become a blooming rose garden. It is still in a dire mess, and all that has happened at the moment is that sentiment has swung away from some of the other pairs and into the dollar. And what tends to happen in this scenario is, unless something major comes out, i.e. an FOMC news meeting on Wednesday, if they come out with something that's completely unexpected, then it could see the dollar tumble. Or equally, it could see the dollar race up if it's positively unexpected. But what tends to happen in this kind of scenario is we get big moves, and the trick, of course, is trying to work out when the heck is it going to stop. The best way to trade, as you know, is with the trend, and therefore what you should be looking for is trying to catch pullbacks from these recent moves. I know many of you missed trades last week, particularly the Aussie dollar, where I've just shown you about the pullback, the logical pullback to 100. You really just have to learn to move on.com. You've missed it. You don't dive in when it sets off, because if you do, Murphy's Law is it will promptly turn around and take you out. So where does it leave us? Well, the British pound, this is a monthly chart. This candle then is not valid until the end of the month, which is another 10-12 days away. At the moment, it looks as though we've got tram tracks and a potential move back down. Price rejected at the 50% fib, almost to the pip, on a monthly pound chart. That move has now gone. Were you going to trade this from monthly, you would wait for a pullback. You'd wait for a close down here, and a pullback to 53.70. However, most of us do not have the luxury of waiting just to trade off monthly charts. Here on a weekly, price has stopped at a double bottom, and therefore you really not going to be looking for entries here at the moment. You're wanting pullbacks. This then is a daily chart, and I showed you earlier we've had a break of that major trend line. We've had breaks below 152.30, which was another major area of support and resistance. If you miss this trade and you fail to get in at 53.30, that would be the most conservative entry to me. These EMAs are going to roll over, and therefore you're going to have multiple reasons why that would be the best area to short this pair. If you're going to be trading intraday, then 53.20 was major previous support and resistance. But let's go down to a 4-hour chart with nothing else on it, and you can see that we're now in a down channel on the 4-hour chart. So one of the ways that you can play this is to add the fibs and start looking for clues for potential areas to short. And hopefully the area here, if you're trading on a 4-hour and you're trading this method, then 50% fib intersection with a trend line and previous horizontal support and resistance will be an area of interest. And again, you want to wait for 4-hour candles to close and look for as many clues as possible to support the theory and tiptoe around the aforementioned news. Equally, the Euro USD on a monthly, we are coming up to a potential triangle breakout, which signifies a move potentially of thousands of pips. Because as you know by now, the theory of a triangle breakout is you measure the size of the triangle, and if you look at the middle figure there, it's 2,000 odd pips. In theory, this is going to drop down to parity, and you never know with Forex. So we're going to wait for the end of the month for that candle to close. On a weekly, we have a very interesting development in terms of market pattern, and this has obviously been developing over recent weeks, and it actually goes back to July of last year. This is a head and shoulders pattern on a weekly chart. This is the head, this is the left shoulder, this is the right shoulder. You then start looking for necklines. You could choose this as a neckline, or you could choose this diagonal line. The theory behind a head and shoulders pattern is as follows. You measure from the neckline to the head at the high of the move, and that is approximately 720 odd pips. That move then should, if we get a break and a close below the neckline, followed by a pullback, We're then looking for a 700 odd pip move down, which spookily will take us to the low from July. So again, big clues that we could be on for a big drop with the euro. If you're trading this from a weekly chart, you wait for a break and close of the trend line, which also happens to be 12800, a whole number and a psych level, and there has been some kind of support and resistance there. So on a weekly, you would wait for next week's candle to break and close below here, following week's candle to pull back. If you're going to trade this intraday, then the same principle, you wait for a daily candle close, pull back with a view to a short. Now, I'm not really trading the euro at the minute for reasons explained before. It has been very messy, but we've had a major break of 12900, 128.75, both for which previous support and resistance and lines I've had on my charts for many weeks now. So these are crucial areas, and if you go down to a 4-hour chart, just like we just did with the pound, then you will see spookily that we have a channel now on the 4-hour chart, and this upper line is an intersection, if this happens early on Monday morning, with the 128.75 line I've just shown you. We then add a fib, and again you can see, just as we saw with the pound, there are fib clues as well on this pair. Now, I don't wish to confuse you here, but you need to get in mind what time frame that you are trading from. But if you're going down to smaller time frames, I don't recommend any less than a 4-hour chart. But if you're going down to smaller time frames, these are the areas to be looking. What's best is when these areas coincide with analysis from other charts. So roughly anywhere around 128.75 or 78.6, 12900. So this area here, anywhere around here, is of interest on the 4-hour. It is of interest on the daily. And the break, as I've just shown you, 12800, would be of interest on the weekly. So your ideal scenario with this is if we get this pullback anywhere around 128.75, we'll be interested to short the euro. Dollar Swissy set off and went last week. I was looking for a pullback to 9500. We didn't quite get it. Only came down to 95.20, so 10 pips off my entry. And then of course it went 200, which was annoying. And then later as the week progressed, the only thing you had was really trading off this trend line. But I like to have multiple reasons. There were not enough reasons for me to be looking to take that trade. Now I'm still interested in the pullback. I'm starting to move my area of support and resistance higher, so anywhere around 95.40. Again, on many pairs you will see the price stopped to the pip almost or exactly on some of the pairs on longer time frame EMAs, and the Swissy here, dollar Swissy, stopped at the weekly 200. So these areas are significant. You can see it on a weekly chart, the 200, and it's sloping down. And on a monthly, you'll notice that the upper Bollinger Band has opened now. So there's lots going on suggesting we're on for big moves on lots of pairs. Talking of big moves then, this is that Aussie dollar. And as you can see on a weekly chart, this was a low back in 2012, in May 2012. And this area has been important support and resistance going back to 2010 and previously going back to 2008. So once again, traders all over the world will be watching this area. Now it's very tempting when you look at this scenario to start thinking in terms of trying to catch a bounce back up. But it is highly risky because of the fact I've just explained it's what's known as trying to catch a falling knife, i.e. a dangerous hobby. However, there are clues with this. This is not something for beginners, but if you are a more experienced trader, I would suggest that you only look at this on a 4-hour chart or longer, or even on a daily chart. But there are clues as to where price may stop the drop on this pair. This current candle, weekly candle, is way outside the Bollinger Band. The Bollinger Band will continue here, so the next candle will be way outside. Usually price pulls back to the Bollinger. So what the counter trend swing trader will be looking for here is a bounce back either off this weekly 55 or even better 9600 whole number and double bottom and major previous support and resistance. A further thing to give you some hope with this is that gold on the weekly chart is also coming down to a double bottom, and as you know, the Aussie dollar and gold are loosely aligned but generally go in the same direction. So that's a clue that price could be about to bounce back up. And finally, silver is already at a double bottom. The flip side of all of this, of course, is if gold and silver tumble, then the Aussie dollar is likely to follow, and then we start thinking about breaks below 9600, pull back with a view to a short. So once again, one pair, loads of opportunities, because on a daily, another option for you to consider, we broke the weekly 200 last week, which is 9800, and therefore a break of a weekly move, you would consider a pullback to there. And obviously if it pulls all the way back to 100, looks unlikely at the moment, but you would be interested to short again once more. CAD, I have no idea at the moment. This was the trade I was looking for. Still have the balance running, so the weekly Bollinger Band has opened. We're coming up to a double top. I'm not in the habit of catching tops and bottoms, and particularly not on the CAD. We do get nasty spikes on the CAD. Personally, I'm going to leave it. I mean, we have broken this area here, so you may consider that. Not for me. Euro pound, once again, until it breaks this area, then if price comes back up to 8,500, I am interested to short. Bollinger Band is closing, which suggests a drying up of price, and if this then comes down to this area and is still steeply pointing down, it gives me even more confidence that price is more likely to drop than to break. So I would be interested in a short at 8,500. Explained last week on this pair, because of the action on the 4 hour, let's look at this. This again goes back to being flexible, and I showed you a couple of weeks ago how I had entered a long on this pair because of an M1 trade, and then I showed you on this 4 hour chart how obvious it was, and really I should have seen this, but if price may start to bounce between these two areas, not start to bounce, continue to bounce between these two areas. So again, if price comes down to 8,400, we'll be interested for a bounce trade on this pair. Now this is the difference again when you come to flexibility. What's going on with the Aussie dollar at the moment? It is dropping like a stone, and therefore trying to catch a bottom on that one is a higher risk than this scenario on the euro pound, because the euro pound at the moment is range bound. It's bouncing off the top, bouncing off the bottom. Finally, the yens, not my favourite pairs. I tend to only trade these when we're looking at major areas. For me, if it came back to 100, I would definitely get involved. If you're looking at these pairs and you trade them regularly, then you could start putting trend lines on here, and a trend line and an intersection of a slight area of support and resistance may interest you. A further option is a break and close above the 200 EMA and then a pullback to 103 with a view to a further long. Mary in the forum, Trade Spotting, is a far better yen trader than I, and if you are interested in mastering the yens, I would follow her, to be perfectly honest. Then you come on to the yen cross pairs, and I've explained this before. This is made up by the price of the Aussie dollar versus the US dollar and the US dollar versus the yen, so this is made up from two separate pairs. The problem here is if the Aussie dollar tumbles and the dollar yen is going up, what tends to happen? You get this tug of war scenario. This is key though. 9900 is key on this pair. If it pulls back again and all things being equal, then you would be interested to long, and if it breaks below here, then you would be interested to short. In recent weeks I tended to pick the wrong one of the three. I favour this week the euro yen because this area of support and resistance is very important, because it's the monthly EMA that it's broken, and we also had previous resistance here as well. So anywhere around 130-100 pullback for a long, I would be interested. I would not take a short on this pair at the moment. As I said at the beginning, we have major dollar strength at the moment, whether it's logical or not. There's a further problem that there are rumours starting that Spanish bonds are going to be dropped to junk status, and if that happens there could be a major sell-off on the euro, which could tie in nicely with this theory of a 700 pip move from your head and shoulders pattern, or even a thousands of pip move from this triangle. So there's things are brewing, and if you look on lots of the cross pairs as well, I think the New Zealand dollar, Aussie dollar, yen, and some of these pairs, there's lots of triangles forming on there, which all usually signify a major breakout one way or t'other. Have a good week.